if I just wrote on a piece of paper in that old-fashioned way of what's going on in the world, a list of facts, dispassionate facts, and the fact that the S&P is up this year is actually extraordinary, which tells you the pain trade is higher. The pain trade is higher because there's so much negativity. Every conference I go to, every discussion I have is about looming inflation, the crushing of growth, the all these terrible policies, and the market's telling you that it's not going to be that bad, and that we really have to quiet the noise around us in our heads and look at profitability of companies, which is what we do as investors, right? So, the reason that tariffs were such a shock to the market and the market sold off 20%, essentially pricing in 2/3 of the way pricing in a recession, is that that original level of tariffs was over 2% of U.S. GDP at $650 billion. Well, that sends a 2% growth economy into recession, right? So that's why the market priced in the recession so quickly. As the tariffs been rolled back, you're back to a growth area of somewhere between 1% and 2%, and the margins on the S&P are going higher on the tech companies and communication service companies, and so the market's going higher as everybody's wringing their hands and talking about how terrible it all is.
Do you think there's still earnings risk in this market? Because I think earnings are going to have to be a big driver of market performance if the Fed's only going to give you 1 or 2 rate cuts in this year, maybe.
So I do think that to sustain the market here and move higher, you have to expect earnings moving higher, not necessarily in the next few quarters, but for 2026, right? Because, over the summer, investors start looking at, forward 12-month, look at 2026 earnings. I think the market's probably telling you that's what's going to happen. Okay. The risk here is that we become a little complacent from the blowout earnings of Q1 coming in at 13% when 7% was expected. It does sterilize the rest of the year in terms of downward pressure on earnings because you can bring that back in for the year. But then we just kind of go to sleep on the fact that there is some earnings risk. And clearly on the retail side, you have seen some demand destruction, and you're going to have some margin risk from the imports. Like, you can see that on the ISM numbers.
Exactly. And the inflation levels, before this whole process, they were, 3%-ish. I'm sorry, the tariff levels were roughly 3%-ish. Now they seem to be 10, 11, 12, 13%, something in that range, not the 20 or 30 or 50% that maybe was the concern. But still, they're a lot higher.
A lot higher.
Is corporate America just going to take that in the margin? Because it doesn't, I guess that, or they can be passed along to consumers. We're not really sure yet, I guess.
I think we don't really know.
Okay.
Like, there's some discussion that also the exporters to us are going to eat some of it as well. I think we actually don't know. If I go back to 2018, and of course the scale of the tariffs were much lower, so maybe it is an imperfect look back. But actually, inflation fell over 2018.
Really? Okay.
Yes, because there was a little bit of demand destruction in the areas which had tariffs. So I think we don't actually know. And in 2018, the exporters ate part of the tariff hit. This is much more extensive. It is akin to a consumption tax. I think there'll be rapid substitution on whatever is being tariffed. I think you see that fairly quickly, but it does mean that there's going to be some hit to certain sectors of the economy. I think likely tariffs wind up a little bit lower.